One of the top performing sectors in the stock market over the past several years has been the alternative asset management space. You've got big names like Brookfield, Blackstone, KKR, Eris, Blue Owl, Carlyle, and several others that have all seen their stock prices soar and in some cases grow their dividends quite rapidly. And this has been due to several factors, including a strong economy, in fact, surprisingly resilient coming out of COVID, extremely low interest rates that have made alternative assets with their higher stable cash flow bond-like yields very attractive alternatives to low-yielding fixed income instruments. People looking for inflation protection even as rates rose with inflation along with it. The inflation protected nature of a lot of alternative assets made them attractive. And really just the growing shift towards needing to invest in infrastructure, especially digital infrastructure for the fourth industrial revolution that we're entering into. All of these factors, as well as a few others, have really driven aggressive investments in alternative assets. And as a result, these big names with large global presences, significant relationships with major investors and institutions, they've really seen their assets under management balloon. And so these stocks have just delivered crushing performance. However, there is one alternative asset manager that has significantly lagged behind. In fact, its stock price has floundered over the past year or so. And in today's video, I'm going to discuss this stock and why I think it is an attractive opportunity right now. But before I get into discussing this stock, if you could please give this video a like, I would greatly appreciate it. Help me reach a larger audience with this video and ultimately my channel as a whole. Thank you very much. Okay, so what is this stock? Okay, enough suspense. It's Patria Investments. Now, Patria is a Latin American focused asset manager, whereas these other ones I mentioned are mostly globally focused. And so that's really why it's lagged behind. And really two reasons for that. One is they haven't quite participated in quite as robust of a fundraising opportunity and investing opportunities as these other asset managers, because again, they're focused on Latin America. And sure, there's a lot of growth and development going on in Latin America, but not quite the same that's going on in more developed markets with the AI boom. Places like the United States and Europe and parts of Asia even are really experiencing this. So that's one big reason why just the market sentiment is not quite as bullish on alternative assets in Latin America moving forward as it is in these other places. And the other big reason is simply that Latin American currencies and equity markets have just really floundered recently with some of the geopolitical upheaval, with Mexico's chaotic elections, some issues with Brazil. They've just caused some issues there and loss of confidence. And so Patria being focused in those regions, doing business in their currencies, they have been penalized for that. But really, the market is missing out here because Patria has actually delivered exceptional results in recent years. Over the past several years, it's delivered a fee-related earnings per share CAGR of about 20%, which is phenomenal growth, especially given they've been paying out a very aggressive dividend, mid to high single digits dividend yield over that period of time. And so when you look at that perspective, it's actually delivering phenomenal economic returns to shareholders, even if the market has not rewarded it for that. In fact, its growth and dividend numbers have been on par with many of these leading alternative asset managers. And so it really seems to be a huge disconnect. And you see that disconnect now in their valuations. Patria trades at only about 9 times its fee-related earnings, whereas a lot of these peers trade at over 20, sometimes even 30 times their distributable earnings or fee-related earnings. Sorry, there is a difference there. And so there's a massive valuation disconnect. And as I mentioned before, some of this is justified. For example, like I said, the growth potential in certain hot sectors is probably better in developed markets like the United States and Europe and in some of the Asian markets than in Latin America, for example, for especially AI-related infrastructure. So, okay, that's understandable. 2, these other ones are a lot larger, so there's perceived safety in the size of their operation compared to Patria. Got it, that's fair. And simply, again, they're not concentrated geopolitically, so they have diversification across multiple markets. That's another advantage. Those are all good things, and I do agree that the large asset managers should trade at a premium, but do they really deserve to trade at 2.5 to 3 times on average what Patria is trading at? I personally don't think that's a way overblown premium, especially because it's not like Patria is risky. They've got a very solid balance sheet. It's going to be debt-free pretty soon. They have, again, very robust growth metrics. They have long-dated capital, quite a bit of permanent capital. They have a growing moat in Latin America. Yes, they're concentrated there, but they've done a good job of consolidating, and they're continuing to work to consolidate the industry to become the alternative asset manager of choice for those who want exposure to Latin America. They're doing a great job. They don't face a ton of competition. Their fundraising has been solid, especially recently this year. And they continue to be bullish on growing in the future. They expect to grow at a mid-teens CAGR moving forward, and that's without any big accretive acquisitions. That's just paying down the debt that they incurred from their recent acquisitions, which they're well on their way towards doing, and then just continuing to fuel organic growth and pursue other low-hanging fruit opportunities to grow their businesses. So again, I think the outlook here is great for Patria. The risks, especially if you just view it as it's my allocation to Latin America as part of a diversified portfolio, I don't think the risks are really bad at all. In fact, it's hard to imagine a less risky Latin American-focused investment. And you are getting a nice dividend too. So I see a lot to like about Patria Investments. And additionally, it's important to keep in mind a potential catalyst for the stock is that next month in December, they're doing an investor day. And there they're going to lay out their vision moving forward for where their capital allocation is going to be. And I do think that's one of the big headwinds that Patria's face is they've had a very inconsistent dividend policy. Initially, they were going to do 85% of distributable earnings. So that includes their fee-based earnings as well as their performance-related earnings that they realize each quarter. Whatever they realize that quarter, the 85% of that they pay out as dividend, the rest they retain to invest in growth. Well, their performance-related earnings have been very inconsistent, and so their dividend has been really inconsistent, and the market has been kind of baffled by that and traded them up and down accordingly. Then recently they said, forget that, we're just going to pay out a flat dividend each quarter. That was effectively a dividend cut because it was on the low end of what they were paying early, and the intent of that was to retain more cash to be able to pay down debt from their acquisitions. But they've been very slow at realizing their performance-related fees they've accrued, and so which now actually make up about a quarter of the stock price. So that's an additional bit of value there that's embedded that has not been realized. In fact, if you put that in there, their price-to-earnings ratio is even lower than the 9 times I mentioned. It's probably more like 7 times. And so when you put all that together, there is some uncertainty there and saying, hey, you're saying this, but you keep changing your mind about the dividend. You're not making the progress we'd hoped on paying down your debt, although they are making progress, and I think they're going to make a lot more progress in the coming quarters as they do realize these fee-related earnings. And so there's just a lack of understanding or confidence in where Patria's headed from a capital allocation standpoint. But that should all go away in December. And I think once that happens, especially if they do commit to a solid dividend, if they say, hey, we're going to pay out a fixed dividend and we're going to grow it over time, or maybe they'll go back to the variable dividend, but at least there'll be clarity around it. I think personally they're probably going to go with the fixed dividend and grow it over time. I think that should remove a lot of the uncertainty and put them on sound footing for paying down debt, becoming debt-free once again, and growing the business at a solid clip over time while also paying out a very nice, sustainable, attractive dividend. And that should really set them up for long-term success. So it's been a rocky road so far for Patria, but I think they're on the right course. Their underlying growth has been phenomenal, even through that inconsistency of where they're going capital allocation-wise, and the dividend looks great as well. So there's a lot to like. It's competitively positioned. Insiders are well aligned with shareholders. They own a lot of the equity. They also own a lot of stakes in the underlying funds that the fund manages itself. Got a lot of permanent capital. We've got a very competitive position in places like real estate, infrastructure, and private equity within Latin America. They also have a growing credit fund as well. And again, the valuation disconnect between them and their bigger peers is just massive. It's 2 to 3 times. Their growth rates are going to be similar moving forward based on expectations. And so while the big alternative asset managers are priced to perfection, or in some cases I would argue overvalued, Patria is significantly undervalued, especially when you include the net accrued performance fees that they have. And the big global asset managers could very well be facing some headwinds like an economic slowdown, geopolitical turmoil. Some of them, like Blackstone, have significant exposure to China, for example. And so if some big conflict were to break out with the Communist Chinese Party and, say, the West, especially the United States, that could really hurt Blackstone. And even where interest rates are headed, again, they could be headed back up. It seems like long-term rates are headed higher. That could be a headwind to fundraising. And certainly, like I said, a recession could cause their funds to underperform. And so, sure, some of those headwinds may hit Patria as well, although, again, its focus on Latin America could make it a safe haven from a China-U.S. conflict. It could also benefit from companies moving out of China and looking for alternative lower-cost labor markets, especially if it's closer to the U.S. for cheaper shipping costs. It could benefit from that with its large exposure to places like Mexico. And so there's a lot to like here about Patria, especially as part of a well-diversified portfolio. So again, I see a major market reversal likely to take place here. There's a huge market disconnect between alternative asset managers and Patria. And I think that there's a disconnect there that will be, if investors buy today, you could really take advantage of this disconnect moving forward with outsized total returns relative to the broader alternative asset management space. So again, hopefully this video was helpful for you, gives you some food for thought for a pick that I think is being overlooked by most investors today. And so if you did enjoy it, you found it thought-provoking, if you could please, again, like the video, subscribe to my channel so you can get more of my content, I'd be greatly appreciative. Thank you very much. See you next time.